When you're a founder, especially a first-time founder, like everything is brand new. You're like, oh, okay, so then how do I do this? How do I set up a cap table? What is a 409A valuation? How do I hire a lawyer? I know how to build a product, but I got all of these other things are brand new. Some of the people that know the most about it are my new VC friends.
Right.
So at some point they say, well, this is how you do it. Remember when we gave you that $200 million valuation? That's because we needed double growth. And I know you're saying you don't want to spend more on marketing, but trust me, spend more on marketing.
I've been there.
Yeah. And then we got your back, right? We got your back. There's more money where that came from. We're sitting on a giant pile of money. So don't worry about the money. And they go spend that $1, $1.50, $1.75, $2, $2.50. And then the real tragic part, back to the question you asked a few minutes ago, like, why did the growth stop? Because that promise, like, we got your back, there's more money where that came from, went away. Sorry, there's no more money where that came from. Wait, now I'm stuck. Now I've hired my head of sales, my head of marketing. I've built this whole machinery, all stuff that I didn't it's not really my home game. I've built it all because you told me to. And now you're saying there's no more money left?
Good morning, Thrivers. Today we have a special episode on a recurring theme of SaaS GTM. Our today's topic is, has SaaS lost go-to-market fit and the case for product-led growth GTM? Before we start and introduce our guest, imagine the following. It's a foggy morning in the SaaS land office. The air smelling of freshly brewed coffee. There's a blackboard. Right now, you don't see it on the screen, but I've seen my guests having a blackboard behind all the time. With lots of intelligent words. The last time I saw it, there were equations and there were people lining up to the door with all GTM questions. Our today's guest is the man actually sitting in that office. He's also called as the Gandalf of go-to-market, sometimes also referred as the Dumbledore of revenue architecture. If you know revenue architecture or PLG GTM, that's the true Renaissance man I'm talking about. Please welcome Dave Boyce, the man I've been adoring and stealthily following on the internet. He is an exec chairman and board of directors of Winning by Design. He's a board member at Forrester. I think he's also a professor at Brigham Young University Marriott School of Business. I first came to know of Dave after I read his early report. I think it's in maybe November when the title has SaaS Lost Go-to-Market. I believe he and David Spitz and a couple of others were putting that on LinkedIn, and I was probably the first maybe 100th people to read that. And since then, I've been a big fan of his work. I've been following him all the time. Dave, welcome to ThriveCast. How are you?
Good, you're embarrassing me. Hopefully we can move to the next section quickly. You're embarrassing me. Yeah, but I think we're going to have fun in this conversation.
Yeah, so do I. So to the Thrivers, I think the recurring theme is about the SaaS GTM. And Dave and I, we connected a couple of times earlier, and we thought about bringing this conversation maybe into a multi-part series. The first one is about mostly setting the context on why did SaaS lose its go-to-market fit? What do we mean by that? There's a new set of terms that we've been hearing all the time. It's GAC, or growth at all costs. So we'll explain this today a little bit. So Dave, since December, since you wrote this particular article, could you explain this a little bit about why 2023 or 2021 to 2023 is the time when this blew off, right? The whole go-to-market fit conversation started blowing off on the internet quite a bit. We've started seeing growth rates coming down. We started seeing the sales and marketing budget going extremely high, the CAC becoming very high. So could you provide a little context of the history behind how did we get to this particular place?
Yeah, well, let's start with how do we notice it? It's embarrassing for us, for all of us that are in the market. We didn't notice it until the tide went out. We didn't notice it until the funding turned off. The thing that was driving all of this kind of growth at all cost mentality was free money. We could assume that there was always another round out there. As long as we had growth going, we could always go fund it with venture money. So money losing kind of growth was actually the thing that fueled us all the way up to the peak in 2021 of the highest valuations. We got up to 20 times average revenue multiple on valuations, 20 times. We're down to 6, just over 6 right now. But in 2021, we were at 20 times revenue multiple on valuations, and we could always raise more money as long as we could keep growing. So when that stopped, when the market stopped funding growth at all costs, then we had to look around and say, well, what's going on? How are we going to get growth if we can't overpay for it?
Let me ask this, before I think you jump into this, why did it stop? And I think you mentioned, you've also written about this, that the first indicators when the VCs stopped funding Series B and Series C companies. I think Sequoia came up with a famous note about what they're seeing on the valuations, I think 2022 or something of that sort. But why did it stop? Why did VCs essentially stop the fire hose? And what triggered the stop, if you will?
Yeah, we saw similar things in 2001. You can only push a bubble so far and before everyone knows that they're doing stupid things. We saw it in 2008 too with the real estate market. Everyone knows that they're doing stupid things and they look around, they're like, should we do one more? And then, yeah. Should we do one more? Yeah. Should we do one more? And then pretty soon they're like, no, we can't do more. So like the Silicon Valley Bank failure was a big marker, and interest rates going higher was a big signal. But everyone that had been kind of led along on this journey knew that at some point this is going to stop. Oh, now's the time to stop. And then the whole kind of market came down. Everybody battened down the hatches. You mentioned the Sequoia memo. Everybody said, hey, we're not going to be the ones left holding the bag here. We're actually going to pull back. So a bunch of people pulled out of Silicon Valley Bank. Silicon Valley Bank failed. And a bunch of people said, I guess this is the end of the run up. And so now what do we do in a post-bubble market?
Yeah, I think some people call it as the end of ZIRP, the zero interest rate funding, if you will.
Right.
So what happened? So when the VCs started pulling the rug under the founders, what started happening?
Now I'm running a SaaS company. I'm going to struggle. I'm definitely not going to get the valuation that I used to think that I thought I deserved or that I even got on my last round. I might not even get money at a down valuation. Take a hypothetical company that maybe raised at $200 million valuation, and now I want to go for my Series B or Series C, and VCs are saying, oh, we're not going to value at more than $50 million. Instead of $200 million, $50 million. Like, no way, then I'm not going to take that money. Okay, well, great. Then how are you going to pay your people? You've got a whole revenue engine over here. You've got a marketing engine that's spending money. You got a sales engine that's spending money. You got a customer success engine that's spending money. You've got a whole product organization that's spending money, and now you're not going to get money anymore. So how do you get back to profitability? It was a big problem. So we saw a ton of layoffs in 2021, 2022, even in all the way through 2023. We saw a lot of people adjusting their cost bases, trying to get back to living within their revenue. That didn't solve the growth problem. That just solved the profitability problem. And some people get there. They had gotten so far over their skis that they couldn't even reduce their cost to anything reasonable based on their revenue. But the ones who did get there then had to think about, well, now what do I do to get back to growth?
Let me ask this. I think you mentioned about VCs stopped funding, but they had the money. In many cases, when you read about it, sometimes it's referred as the white powder of the VCs. They had a lot of white powder. So why did they stop funding? What incentivized them to say, hey, we're going to do a down round? Because there was money in their banks. In fact, most of the VCs had raised multi-million-dollar funding raises in 2021, 22. So what was the impetus of they saying, hey, I'm going to do a down round?
So the public market shut down. So if I'm a venture capitalist, to your point, I raise money from my investors, right? They're called partners. So I'm a venture capitalist. I raise money from limited partners. In order to raise money from limited partners, I have to promise returns, which means that you're going to invest in me, and then I'm going to go invest in companies, and then those companies are going to sell for more than the valuation where I entered them. And a lot of those exits are to the public markets. But if the public markets aren't buying company or are closed business, then how am I going to go monetize those investments? Well, I could sell to other companies, but those other companies also have to go public in order to have currency to buy me. So when the public markets shut down, kind of all of those exits went away. And so now, even though I'm a venture capitalist and I've raised a lot of money, I can't reasonably, until things kind of settle out and I see what the new game looks like, I can't reasonably deploy at these 200, 300, 600, $1 billion, $2 billion valuations on the hopes that there's an IPO in the near future, because there's not an IPO in the near future anymore.
Got it. And it's very interesting to think about this. And I was talking to somebody else, and he was mentioning to me that the up market is always a good ride as long as it lasts. But there is a momentum towards that up market, meaning everyone wants the market to constantly keep going up. I think you mentioned some time back that the VCs would, I'm imagining this situation where the startup founders are going to the VCs and they're saying, hey, here's my valuation and I need you to invest. The VC had a choice at that time, 2020, 2021, they would say, I'm going to take a large piece of your company. But if the valuation is too small, you'd lose a lot of money. So I'll increase the valuation at that time. So I've heard many founders come back and even write out on LinkedIn posts that they got a pitch back from the VCs to almost do 1.5 times, so 1.6 to 1.8 times the valuation on what they suggested. So the VCs are coming back by increasing the valuation. And I think looks like what you're saying is that trend stopped in 2022, 2023 because of the public market. Am I right to maybe connect the dots?
Oh, for sure. Yes. So if I'm a VC, I'm thinking about eventual exit. Eventual exit is really, really high. That means I got to get in at medium high or low, but I can't get in at low because no founder will take my money. Like if I'm a founder, you've been here, I've been there. If you're a founder, you're trying to minimize dilution. And the way that you minimize, so if I'm going to take a $20 million check, then I would like to have a $100 million valuation so that I don't have to take a lot of dilution. If I only have a $40 million pre-money valuation, then I'm going to take a 33% dilution. That means 33% of my company I'm going to hand off to the venture capitalists, and I don't really want to do that. So if I can get a higher valuation, then I have less dilution. So that whole game, that whole interplay between that you just described, it's all about VCs trying to get into the best deals and therefore offering the best terms and therefore offering these 1.6 or 1.8 times valuations, like, because that's a better term for you, right? So now you'll let me into your deal. But then in order for me, if I now switch roles and I'm now a founder, in order to justify that higher valuation, I got to promise you're going to tell me that you're going to give me lower dilution on the basis of higher valuation. Cool. And then the VC says, yeah, but you got to grow faster.
Okay.
And then they, oh, I got to grow faster. Okay, so what do I got to do? Oh, you got to grow 100% year over year, 200% year over year, triple, double. Like, whoa, That's really fast. So now what do I do? So I knew how to build a product, but now I got to take it to market, and I got to take it to market even faster than I was planning on. So we end up with all of these kind of mutual promises from LPs investing in VCs, VCs investing in entrepreneurs, entrepreneurs now getting stuck with these expectations around hyper growth. And that's how we ended up 2021. We ended up with peak valuations based on that.
So let me connect a few things. I think you just mentioned growth at all costs, and the VCs are essentially asking the founders to grow faster. And the only choice that they have to sustain that valuation is to grow, I think, triple, double, or double that we talked about. Tell me a little more about, if that was the case, why were they not able to grow? They had the money. Sure enough, the valuations might be iffy, right? So the valuation, they might have a down, but they had the money. They were also spending adequately. So what stopped the growth rates? Essentially, what declined?
While we were spending the money, we were growing. We just weren't growing efficiently. So we were spending, to get $1 of new ARR, and you saw this in the article that we did in December, to get $1 of new ARR, we ended up spending $2.54. It makes no sense. Ideally, according to the magic number, I'd spend $1 to get $1 of recurring revenue. That would be amazing. And $1, get $1. Okay, well, how about spending $1.50? Is that good enough? Anybody care? No, don't care. You'll keep giving me money to do that? Okay, I'll spend $1.50. Okay. Well, I'm still not growing fast enough. Could I spend $1.75? Of course you could spend $1.75. Like, we gave you a ton of money. Spend $1.75. Just give me the growth. Could I spend $2? Of course you could spend $2. So now I'm double what I should be. And the VCs are still saying grow faster. Okay, how about $2.25? How about $2.50? We got all the way up to $2.54. Overspending on marketing, overspending on sales, overspending on kind of the entire GTM, even on customer success and renewals and expansions, until we were $2.54 for every $1 of net new ARR.
Yeah, so that's very interesting. That's an interesting marker when growth started declining. And I think what you mentioned about the S&M cost, the sales and marketing budget, I read an article, I think only CFO or somebody else also mentioned that the money that was spent was a large chunk of marketing money. Ads was taking about 20-30% of the entire S&M budget. Acquisition costs were much higher, and because of that, there was flack there. But could you tell a little bit about, while that was happening, the founders' instinctive behavior is take a large portion of that money and make their products better. They didn't do that. They went to sell whatever they had. I mean, is that a human behavior just to get pressured by the VCs to say, hey, grow, and you stop making things that you're intuitively good at to make your products better? Now you're focusing on purely on distribution. So that shift is a DNA shift. And I think you've been talking to a lot more founders than I have. Why did that behavior stem into being? Why would they go focus so much on buy growth at all costs? What was their reasonings?
Yeah, this is the sad part. Because you're right. You and I are both founders and founder fans, and we're going to root for founders, and we want founders to survive and thrive. When you're a founder, especially a first-time founder, Like everything is brand new. You're like, oh, okay. So then how do I do this? How do I set up a cap table? What is a 409A valuation? How do I hire a lawyer? I know how to build a product, but I got all of these other things are brand new. How do I assemble a board? What's an independent director versus a non-independent director? Like what's preferred shares versus common shares? Like I don't know any of those things when I start as a founder.
Yeah.
So people are telling me, and some of the people that know the most about it are my new VC friends.
Right.
And they're telling me like, well, this is how you do it. So at some point they say, well, this is how you do it. Remember when we gave you that $200 million valuation? That's because we needed double growth. And I know you're saying you don't want to spend more on marketing, but trust me, spend more on marketing.
I've been there.
Yeah. And then we got your back, right? We got your back. There's more money where that came from. We're sitting on a giant pile of money. So don't worry about the money. And so then these really good souls, these founder souls are saying, well, I guess that's how it's done. And they go spend that $1, $1.50, $1.75, $2, $2.50, building a piece of the business that is not, to your point, it's not their core domain. Knowing how to optimize marketing is not usually where a founder comes from. A founder usually comes from how to build a product. Knowing how to optimize sales is not usually where she comes from either. She knows how to build a product. Okay, so now I'm way over my skis as a founder. I'm taking advice. I'm paying the money. I'm doing what I think I'm supposed to do because I'm a curious person and I'm a student of the game, and you're telling me how to do it. The experts are telling me to do it this way, and I do it this way. And then the real tragic part, back to the question you asked a few minutes ago, like, why did the growth stop? Because that promise, like, we got your back, there's more money where that came from, went away. Sorry, there's no more money where that came from. Wait, now I'm stuck. Now I've hired my head of sales, my head of marketing. I've built this whole machinery, all stuff that it's not really my home game. I've built it all because you told me to. And now you're saying there's no more money left. So then I had to start firing, and that's tough. I had to start firing friends, reducing, resetting. And it wasn't only first-time founders that ended up in this spot. And layoffs, I'll cut 20%, I'll cut a third, I'll cut half of my company. And once I did that, growth also stopped because a lot of the growth that I was overpaying for now doesn't show up at all. So only the growth that's available to me now is the stuff that I pay $1 for $1 on. And that's way less growth than I used to have. So we saw growth rates come down too.
Yeah, so that's interesting. We will have it in the show notes. I think David Spitz, your blog post has various links on these numbers. We'll qualify this a little bit. So Dave, I think you mentioned about growth at all costs had a deterministic effect on the CAC. Right? The CAC value went up from $1 and a couple of cents to $2.64, which is purely from the net new revenue standpoint. But where was that funding utilized? On deeper looks, and we can touch upon that a little bit, you mentioned about the founders will go ahead and hire a CSM team. So there was a CSM team now, which didn't exist earlier. There was large marketing spend with ad money and quite a bit of content writers and marketing guys getting there. They had to spend on the sales guys who were initially doing some baseline cold calling, talking to their Rolodex of customers. Now they had to hire a BDR team who now you created a massively large SDR and a BDR team just constantly doing a cold calling, and that money was not getting enough returns over there. Because there were so many people and there were managers, and there were AEs had their managers, and regions had their managers, and SDRs had their managers, and the CSMs had their managers. All of that will constitute a large spend on that. So is all of that, do you consider that to be as part of the sales and marketing budget, which includes all of the sales, AEs, BDRs, all the tooling costs, all of the marketing costs, as well as the CSM? Or do you see that S&M spend is only sales and marketing? How do you see the sales and marketing spend?
You would include all of that. And a lot of people talk about cost of acquisition as well as cost to serve. Cost of acquisition is how do I get someone from kind of awareness to interest to decision to kind of commit. And then cost to serve is how do I get someone from commit to onboarding and live and then renewal and expansion. But all of that I'm spending on maintaining and growing, acquiring, maintaining and growing annual recurring revenue. So all of that became too expensive when I couldn't pay for it with venture money anymore. And I had to rethink everything. And this gets to kind of your domain, Guru. You're enabling companies to use their product to actually perform a lot of those features. So in a product-led go-to-market arena, can the product sell itself? Can the product deploy itself? Can the product renew itself? Can the product expand itself? If it can, if I can hire the product to do those jobs instead of humans to do those jobs, I'll pay the product less than I'll pay a human. So if I can hire a product to kind of do that. That is one way out of this bind. If I didn't build that way from the beginning, it's going to be tough for me to retrofit it. But that's one way to avoid all of those high go-to-market expenses that for all the roles that you just talked about, is anywhere the product could do something that a human used to do.
Yeah. So we'll come back to the product-led growth GTM a little later. But one last question before we wrap up today's. So while all of this is happening, growth at all costs is not working well. One intriguing metric that always kind of hurts me a bit is while the growth is going down, the sales and marketing spend is actually going up. Could you explain a little bit about why is the sales and marketing spend going up?
I don't think it's going up on an absolute basis. I think it's going up as a percent of newly acquired revenue.
As a percentage? Okay, got it.
Yeah.
Okay.
Yeah. So I cut my expenses. That's good. That helps my EBITDA problem. But I'm not being as efficient as I should be because the growth has just gone away. And then part of the problem, Guder, too, is a lot of the SaaS ecosystem buys from itself. Like Gong buys software from Chorus, and Chorus buys Snowflake, and Snowflake buys software from Outreach. It's like, but when everybody's growth expectations start coming down, they start needing less software. So we just wasn't as much out there to get, even if I was willing to spend money. And of course, I wasn't willing to spend money anymore. So we just had a lot of things putting downward pressure on this. And I think about it as the tide going out. The tide goes out, you can see where all the rocks are. Well, we had a lot of rocks. We're overspending here. We're doing it wrong there. We had overhired here. So the tide goes out. There's no growth available, no capital available. I can see all the rocks.
Yeah. Super. I know we are out of time today, but we will circle back next episode and we'll talk about how do we remedy all of these problems. We may not have answers to all of them, but at least we'll touch upon some potential aspects of remedying some of the high S&M spend, reducing the CAC, and figuring out a way if a product can sell itself. So until then, thank you so much for listening and watching us over YouTube and various other places. We'll circle back in a couple of weeks and we'll have very likely a live LinkedIn session or even a podcast to follow through. Thank you so much. And Dave, always a pleasure to learn from you. Thank you so much.
Cliffhanger.